December 17th, 2022. I'm sorry, everyone. The data is still bad. It's not getting a lot better. CPI 7.1 is not good. I mean, people cheered for it. They were FOMOing, speculating, hoping for a pivot. And, I understand why. Everyone is grasping at straws because in nature, with the stock market, you have to be bullish because over time, it does not make sense and doesn't pay to be a bear. You could be a bear in certain stocks, but in general, in the market, you have to be bullish over time. So everyone's grasping at straws. We went through the roof on the 7.1 that beat a 7.3, but 7.1 is far away from 2. And I was trying to tell people on Reddit that in order to have a very, very good number, we need probably like low sixes, but we got a 7.1. Because low sixes, then the Fed could kind of really back off. Instead, what did we get? When the Fed came in, I was thinking, before the Fed came in, this is before they came in, that we're going to get a zero point 0.5 hike, and I wrote it on Reddit, and we're going to get two more quarter points. So right now we're at 4.4. We already got the 0.5 hike. The Federal Reserve consists of 12 governors, 12 main governors, and one chairman, Jerome Powell. They have 7 alternate members, so 19 people altogether. Out of the 19 people, only 2 people out of 19 people see it at 4.9, which means 2 more of the 0.25 hikes. So before the Fed came in and we do, hooray, hurrah, the 7.1, and then we got smacked in the face with Powell. So before we got smacked in the face with Powell, even though I was on the sidelines because I was ready for the punch in the face. If you read the Reddit, I was thinking 0.5, 0.25, 0.25, right? That's 4.9. But 2 out of 19 see 4.9, all right? These are people that control the market. 12 out of the 19 see us at like around 5.1, 5.2. So that means another 0.75 increase. And that actually leaves 5 people that see it higher than that. I think it went as high as like 5.75. I think that's way out of the question. Because honestly, I do believe that right now at 4.4%, that the Fed unfortunately is going to overshoot us and put us into, they keep saying soft landing, hard landing, but no one has clearly put what that means. So I will, because no one has put that. Right now, the Fed expects GDP for the full year at 0.5. So I guess that's a soft landing because normally we have positive GDP. I guess is a hard landing. 5% unemployment with flat GDP is a soft landing because, like I said, no one has said anything. So I'm going to say a hard landing is a full year of negative GDP, whether it be negative 0.5 or just negative 0.1 negative GDP, because no one, like I said, no one has defined it yet. So we get a full year of negative GDP. I guess that's a hard landing. And if we get over 6% unemployment, that's a hard landing. And soft landing is flat or 0.5 with 5% unemployment because once again, it hasn't been defined. Keep in mind, 2 negative quarters in a row is orderly recession. Because it happened, they're trying to push us off. Now, gotta be honest, I was impressed that for the third quarter, that we did have positive GDP. We had 2 negative GDP quarters, and we had a positive 2.9 GDP for the third quarter. However, of that 2.9, and you could look it up, it's not FUD, 2.6% were exports. So what does that mean? We without the exports, we had 0.3 GDP, and it's coming off of 2 negative GDP. We're already in a recession, but this recession is very, very weird because We had trillions of dollars just pumped into the economy. We're coming off of COVID. We have jobs, so this is gonna be unlike any other time in history. So we're in a recession. It's a strange recession. It's not a deep recession because we still have close to flat or a little bit above flat GDP. We have jobs, so it's not like bad yet, but it's getting worse. So unfortunately, the Fed, the way it looks like after the meeting, I have to agree with the Fed because the Fed has been hawkish the whole time. They have not pivoted. They have not changed anything, and the market is just reaching. So the Fed is basically 2 people out of 19, and we don't know who said what, but 2 out of 19 were 0.5, which is 2525. Most of them 0.75. So unfortunately, we got to do 0.75. And what does that mean for us? Because too many people are focused on CPI. Too many people are focused on the Fed. What we need to focus is on what it means for our companies. And unfortunately, even before, at 3.88, 3.9, let's not go crazy. 3.9. At 3.9, our companies could not handle it. You're going to see in earnings coming. It takes 6 to 9 months a lot of times for just one hike to go in. We went from 0.125 at the beginning of the year. Right now we're at 4.4. 4.25 in rate hikes in less than a year. It's going to crush companies. We're seeing so many companies going out of business, but you gotta understand this is not just for the stock market. All right, all these people that are saying stop raising rates. All these rich people aren't out in cities. They're not seeing the crime. They're not seeing what's going on. Right now is December 17th in Connecticut. They have until the 9th to pay rent. I have 8 people that haven't paid me rent yet. Now I'm the nice guy, and we got Christmas coming, so I'm not gonna evict people till January. But that just gives you an idea. I have 8 people that did not pay me rent. And I do contact them. I am understanding, and these people can't afford utilities. They can't afford food anymore because inflation is going through the roof. The value of the dollar has dropped so much that they have to decide whether they're going to pay rent. You got to understand that majority of people here in the United States have incomes lower than $50,000. The median income, I believe, is 64. But that's taking the average of the highest and the lowest. It's not the real average. The real average, if you take all the people and not just take the average because you're taking the super high, is probably close to 50,000. It's probably close to 50,000. If you took all the numbers and didn't take the average and you went out to see what is the number that it falls in, is 50,000. If you're making 50,000 and you're paying rent, let's say it's $1,500 a month, you're talking about $18,000 a year in just rent. And then your 50,000, then taxes, that's going to leave you with what? 38? Let's just say 40. That's going to leave you with 40 after taxes. Then you take out the rent, that's going to leave you with 22. And then 22,000, 12 months. I mean, how are you going to live with that? You're paying utilities. You might be paying a car. That's leaving you with nothing. That's not even 2,000. Nothing. You won't be able to live if you're the average person. That's what they got to worry about. They got to raise rates. Unfortunately, they're overshooting us. And what we have to worry about is the company that we are buying. Are they beating earnings? Are they growing faster than the S&P generally? Generally, the S&P grows at 20%, 10 to 20%. A stock on the S&P 500 generally grows sales at 10 to 20%. They generally grow earnings between 5 and 10%. Sales is top line, earnings is bottom line. The stock that you're in, are they doing that? Do not say It's less worse, okay? I'm tired of that. People are trying to say, whoa, well, this is better than expected. Better than expected, but sales were down 10% year over year. Earnings are down 20% year over year. Like Nvidia, last earnings, it was bad earnings. The report, earnings I think were down 75%. And sales were down 20%. Now, this is me because I do the research. But everyone else is trying to paint a different picture. Watch when Nvidia reports again. Remember, I said S&P grows sales at 10 to 20%. All right? Earnings at 5 to 10%. Generally. We're just talking about generally. So if you're in a stock that is not growing at that pace, 10 to 20, not growing earnings at 5 to 10 is worse. And if that happens to all the companies on S&P 500, guess what? Earnings are going to go down in the S&P 500. In the beginning of the year, a lot of analysts had S&P 500 earnings at 250. We earned about 210 because we're not trying to confuse people. So we earned about 210 last year in 2021. I expected some growth, so I put us at 220. A lot of people were overshooting because we came off the pandemic. Everything was closed down. So we had earnings from like 110 to 210. Everything was closed down. So we were in good hands to go through the roof. So we were just shooting up. We were all mooning. Earnings went from 110 to 210 to record highs. And they expected it to keep going. So they expected 250. I'm expecting 220. I was expecting 220. Now I have my earnings at about 215 on the S&P 500. 215, and normally the S&P trades between 17 and 18 times earnings. Like you need to if you're trading a long period of time, you need to be aware of these numbers so that you know that this is not normal. You got to know when things are not normal, and you sell into not normal if things are getting bad. So even if you don't go with my 215 and Goldman Sachs is a big name at 224, and you take 224 times 18, let's see, because this is Goldman Sachs, right? Nathan from Queens is no one, but Goldman Sachs is Goldman Sachs. So let's take this 224, 18. So it's 4,032 if we earn 224. That's where they're at. But you know what sucks about that? What sucks about that is they see 224 for next year also. So that means flat, no growth. So you can't give 18 times earnings. Well, not you, but I can't give 18 times earnings if I have an S&P 500 stock that does not grow sales and does not make money. Because how are they going to pay me money? They're not going to be able to pay me money if they're making less or not growing. They're not going to make it nice for me. I'm the investor. I'm the trader. I want to buy you because you're doing something better, not worse. Not worse. So I'm going to give it a 16. So if we go 224 times 16, and this is Goldman Sachs, we're at 35.84. We're at 35.84. And where are we at right now? I think 3,900 on the S&P 500. So what is the upside? So this video went pretty long, but the state of the market is pretty bad. And this is why I'm going it through with you so you guys can understand also. Nathan from Queens, Ultimate Traders, December 17th.